Well, good evening, ladies and gentlemen, and thank you very much for being with me today on this better than spring day. The sun is shining, the sky is blue, as is the ocean, and it's a very, very pleasant day, I can tell you. Here we are. Oh, Jim, thank you, Jim. Sound is loud and clear. Good. Well, if we can get across to Jim, I can get across to all of you. Thanks so much. Okay, let's see who's here today. Well, our usual friends are here. Here we are, Colin over in New Zealand. Nice to see you, Colin. Florian, we haven't seen you for a long time. Glad to have you with us. George, the same. Gig over in North Carolina. Here he is. He's a wonderful fellow, Gig, and he's a very, very keen golf man. We're lucky to get him off the golf course to attend what we're doing. George is with us. Nice to have you here again, George. All of the here we are. Gregory Palladini's with us. Thank you, Greg. Good to have you here, of course. And Jim, I said hello to Jim. There are plenty of other Jims as well. Lots of Jims, a few Joes. Joel from Vero Beach. Thank you, Joel. Kevin from California. Good to have you with us. Mark L. Of course, wouldn't be a party without Mark. He's an absolute stalwart of Danielcode. Been with us for a long, long time. Tutorial graduate. As is Norbert, who's up in that really cold country in Canada. And Partho, who's a fairly new guy. He's doing a tutorial at the moment. Very clever. I think he's going to be very interesting to us. Peter Mack, who's not a day trader. There we are. Sanjay. Good to have you with us, Sanjay. Welcome. Sean down in Adelaide. Good to have you. Todd as well. And Vicky. Grand to have you with us, Vicky, of course. Yes, here we are. And Anthony DD from Chicago. Hello, mate. How are you? Long time since we've had a talk. Are you still acting as a broker, Anthony? You're still in the business? Anyway, let me know when you have a chance. Absolutely grand. Okay, so I started to talk about Jesse here, and of course he was famous for the long pull, and he was a young man. He was called the boy plunger. Even then, he was known to be the very, very definition of all in. And hi, private trader Anthony. Good to have you here, mate. Wonderful. Yeah. So Jesse, of course, the boy wonder, was a fearsome, fearsome plunger, and it was all in. Really meant all in for him. And of course, we praise him and we marvel at some of his feats, but there's actually a salutary lesson in Jesse's trading, because he went bankrupt at least twice, maybe three times, and he finished up putting a bullet in his head and writing his wife a note that he claimed he was a failure. So things went very poorly for Jesse in his later years, and a whole lot of that was attributable to the start of regulation. Before that, he could get away with all sorts of things without other traders knowing your position. And Jesse, of course, was a master at that. He actually cornered the cotton market. And he actually got called in by the president of the United States, who asked him, would he please let the corner slip because it was doing too much damage, which, I mean, if anyone can corner a substantial market like cotton, is some operator. Anyway, he was wonderful. I admire his bravado might even be the word I'm looking for. But we do have to take into account the times are different now, and even for Jesse, if you didn't have your stop loss on in place, you finished up being very badly damaged. And that's kind of interesting, because in the last couple of years, more last year and the year before, we've seen some spectacular failures in the futures market. which are always taken as a salutary lesson to beat futures and options guys around the head and say, oh, well, you should just stick to stocks. They're easy, they're simple, they're easy to understand. Well, that's actually not quite the truth at all. But risk management is paramount. And all of these events that we've talked about, the London Metal Exchange being blown up exactly. I haven't heard how all that litigation's working out, but it's been a couple of years now. But quite simply, the operator, I think he was a Chinese gentleman, he was just acquired a heap of aluminium smelters in Indonesia, and he already had his own. He's a big operator in aluminium, and he thought he could absolutely flood the market, so he didn't bother with his stops. And of course, the smarties found out. They always find out. Goldman Sachs' name's prominent in there, and they just ran it up, and it would mark the trade around $23, $25. All of a sudden, it was $100. $100 bid, no seller. And of course, a couple of the brokers for the London Metal Exchange, they couldn't settle. They were in trouble. A whole lot of people were in trouble, so they went through an extraordinary procedure of decaying their own exchange and literally cancelled all the orders for the last day and a half. And there's some very substantial litigation going on about that. So the lesson hasn't changed. No matter how good you are, if you don't trade prudently with a stop loss, and set your limits and know what you're doing, you can get very badly damaged, not only in what we trade, the futures market, but any market. It's all the same. I mean, start with the first rule. There is no order without an accompanying stop loss. And the stop loss is linked to your order. If the order is filled, OTO, one triggers the other. You see, I would have said if done, but you see I'm getting hip with all the new the terminology. Jim, you'll be impressed that I knew what OTO was, mate. And yeah, it's linked. If your order gets filled, the stop loss goes on automatically. There's absolutely no exception to that. You do not trade without a stop loss. If you do, you're an idiot, and you're going to get caught. You may get away with it for a while, but you're going to get caught. I remember quite clearly what was happening back in just a couple of years after the dot-com high. I was trading with a fairly prominent Chicago broker, and one of the chaps got very excited about my trading and said, can we copy your trades? I said, I guess it's probably illegal, which most certainly is. Brokers aren't supposed to do those things, but I said, I'm not going to tell anyone. So he had a little group of young brokers who were all trading, following my trades. And I did make the point to them, things are getting pretty hairy. Make sure you've got your stop loss on. Oh, yes. Well, it turned out later they didn't paste the stop loss. They reckoned that they had, they were trading on the floor at the time, and they reckoned that they could get the order on stop losses on so quickly that it wouldn't matter anyway. The inevitable happened. I think it was Greenspan raised interest rates, and he didn't do it at a scheduled time when there was a meeting, and he didn't do it before the market opened. He did it at 10:30, 11 o'clock, just when the market was really loading up, and the response to the market was so dramatic. And these guys got wiped out because if your order is not in the market, one day it'll catch you. So your order has a linked stop loss, whatever you're doing, and there's no order without the stop loss. Okay, that's my little bit of moralizing for the day, but boy, I've seen it so often. Let's move on. We know that markets are rational, orderly, and sometimes predictable, and the Danielcode is a set of proprietary ratios that control time and price in all markets. In fact, they actually are created from time signals, and we simply take those time signals, which you look at them on a page, they're vertical, and we just place them on the charts horizontally. We don't make any adjustment, use nothing but time ratios to create price. And for those of you who haven't already, I urge you to go to the chart archives. There's a link on the Danielcode website, and you'll see over 45,000 members charts that I've created since the website went public in late 2007. And you will be hard-pressed to find a market that's ever turned anywhere except with target recognition at the Danielcode numbers. So if you're a new trader, you're probably scared of the market. Don't be. Markets are your friend. They exist to give you health, wealth, and happiness. But there's a caveat to that. You're either trained or you're untrained. And if you're untrained, you're going to lose your money, and you're going to lose it really, really fast. If you're trained, you have what I believe is the greatest opportunity in the world to make money, big money, but you have to be trained. You have to know what you're doing. Once you're trained, it's really easy to make a lot of money. When you're untrained, it's really easy to lose all your money. So get yourself trained to your own satisfaction. Better still, get me to train you, and then you will be in a great position for the rest of your life. Okay, so Jesse Livermore. We talked a bit about Jesse the last time, and I'll just let you read through this. You're talking about an era where there was very, very little regulation, if any. And some of the things that he did were quite extraordinary. Others were propitious. You can see here he's saying he took a massive short position in Union Pacific Railroad the day before the 1906 San Francisco earthquake. So that was a gimme, wasn't it? It was very good. And there's no doubt that he was a massive trader, and he did massively well. At one stage, he was probably close to being one of the richest men in the world. He was just a massive trader, very, very intuitive, and didn't worry about risk very much, and that's the problem. So what I admire him for is the fact that he cornered the market in cotton. And President Woodrow Wilson called him in and said, or gave him a call and said, could we have a talk? And when he came in, he said, well, would you agree to sell back the cotton at break even? Which he did. He was an obliging guy, and he looks like it. And you can see here some of these incredible decisions he made. However, he went bankrupt at least twice that we know of, and too much risk guarantees you failure. It'll catch up with you one day. It caught up with Jesse, and caught up with him in the end in a pretty dramatic way. So we need to know what our risk parameters are. We need to control, react to market as the market moves against our position. And we have to be aware also of portfolio risk. If you're over-invested in correlated positions, it just goes out swoosh. So make sure you understand about correlations, which I talk about here quite often. So being brave in this business can have seriously bad consequences. You don't have to position yourself to fight the market. If you understand how to trade, you just work with the market, and it'll work with you and for you. And it's amazingly accurate. I'm staggered every day just how well it works. But there's always a lot of interest, and I have to say, for reasons I do understand, about trading for the long pull, as Jesse used to call it, meaning staying in a trade for a long, long period. And I'm not quite sure why it's of such interest to people. I guess the basic answer has to be ignorance, that they don't understand about futures trading. And it's a bit like a dirty secret, futures, isn't it? Everything is, all the promotional work is about stocks. Um, and I used to trade stocks. My father was a great man for stocks. He did very well. And while he was alive, I used to trade stocks with him. And after that, it didn't interest me. It was too slow. I thought, totally boring to me. Just the way my mind works, it was just not enough action and just too slow. And then I found out about futures and never looked back. But let's have a look at what is the basis of understanding this long pull trading. You're looking at a chart here. This is actually the S&P since January 2022, the all-time high. And you have to think it's been an amazingly light correction, hasn't it? If this is a correction, and that's all it is so far, and it's been incredibly precise. If you looked at some of the earlier webinars that I've done recently, I showed you how the market from that high has gone exactly to the Danielcode ratio retracement of the COVID flash crash. And I mean, perfectly, almost to the tick. In the same way, if you haven't already seen it, it's on the website. I don't know if you can still access it. This whole rally, the NASDAQ, topped at its Danielcode black line, which is 89%. It's the last level of support or resistance on any chart. And it absolutely nailed it to within 16 points, which was well within our allowable tolerance for market recognition. But anyway, it hasn't been a straight shot either way, certainly not the run down. So start with, if you're interested in trading long term, start with the basic 6-day chart. This is a chart where every bar is 6 trading days. So it allows us to look at much longer periods of time. It compresses them. And that's where we start on the 6-day chart. So markets, the basic assumption is that markets will naturally strive for balance. A balanced market, there's equal pressure both ways, long and short. And that's the basic assumption of markets. Now, we know that doesn't happen very often. We know that markets tend to be optimistic and euphoric, or they're sad and depressed, and the price moved accordingly. This idea of the market being in balance was very popular about 40 years ago. And there's a study in Trade Navigator called Zero Balance. And you can see from that some of the thinking that was going on about this some years ago. And it measures directional market pressures. I don't think it's very good, but it's there if you're interested. What I am much more interested in is overbalance of time and overbalance of price. And I'm particularly interested in overbalance of time. And these techniques point us to the all-important market trend, which is everything. So here is the S&P. This is the index chart. And what I put on it is just a very simple proprietary study that gives me an uptrend or a downtrend. This is the uptrend and the neutral areas. I haven't put the downtrends on yet, just to let you get accustomed to seeing how dominant those up sessions were leading into the 2022 high, and equally how dominant has been the run up into the July 2023 high. I mean, it's just been go, and the angle of attack is pretty steep, which I'll talk to you about later. So let's move on. So we can see here how we've gone through this period of having dominant blue colors, then all of a sudden they're disappearing, and we've still got plenty of blue on, particularly later. But looking from 2022 down to the October, January to October, it's not so much blue, is it? In fact, we can then add the other side of the equation, which should be red, but in fact it's pink. And you can see how there was very little pink. You're only getting 2, maybe. I don't think there's even a 3-bar session leading up to the 2022 high. And then, of course, after that, we start getting more pink, more pink, more pink. Look how quickly the blue's gone back to dominating in this run-up to July. I mean, it's very, very significant. I mean, I've been saying the whole rundown, it's never felt to me like a serious correction. And emotionally, it hasn't been. There's been no big bars down. There's been no drama. There's no one really seriously stressed about this. And, of course, what's happened is that the Fed is making a show of tamping down inflation. The Australian government and most Western countries, with the exception of Japan, will more or less follow the US Fed. It's the big daddy. And certainly the Australian Federal Reserve here, which is called the Reserve Bank, Australian Reserve Bank, it follows the US Fed pretty much slavishly. And what I found really interesting is we've been getting this fight against inflation, if you like, going on and on and on. And with certainly interest rates have just been roaring up. And they are now becoming significant. But having said that, let me tell you that we came back, my wife and I and the family were living in New Zealand for about 12, 13 years. We came back from New Zealand to Australia in April 2013. And, of course, the first call of business was to buy a house. And I can tell you that at the time, the bank interest rates in April 2013 were very reasonable. Nothing exciting about them. They weren't particularly low. They were not high either compared to history. But here's the point. Until about March this year, despite all the huffing and puffing, all that's happened on the long-term interest rate, which the housing market relied on, is it's gone back up to those levels that were prevailing in April 2013. In other words, it's taken up all that slack, but it's only just got to a neutral level, in my view. It's only in the last couple of months, the last 1 or 2 increases that it's got past that level. And it's not huge, it's not significant. So essentially what the Reserve Bank has been doing, they got the interest rates down so low, the zero bound, as it's called, that all of this work to so-called stem inflation has just really got us back to a little bit more positive than a neutral position. Now, add to that the government spending, which Biden's not the only one. He's the world champion. There's no doubt about that. The spending by the Biden administration is just make your toes curl, and there got to be consequences. And as I say, he's not the only one. Trump was a world-class spender. So was George W. Bush. And in Australia, we've got a new Labor government. Labor government equates to your Democratic Party in the States. It's the left-wing government, and parts of it are pretty left-wing. And, of course, they've been out of power for 19, 20 years. So all the pent-up wonderful ideas and stupidity that some of these people come up with are now becoming a government policy. And I have to tell you that next month we have a referendum to change the Australian Constitution. Now, changing the Australian Constitution is not easy. It's designed by the folks, the founding folks who wrote it, to be tough, and you have to get a majority in a majority of the states as well as an overall majority. But this is a pretty controversial amendment, and I actually don't want to talk to you about it other than to tell you that it's there and it's real. It's such an inflammatory subject that it's better that hard-working traders like you and me avoid it altogether, other than to say the immense spending of this Labor government in New South Wales is no different. They've just got so many policies, new policies that they're trying to implement, but the cost of money is absolutely astronomical. Exactly the same as with Biden's policies in the US. And all of that money is essentially stimulus. It's not direct stimulus, it's indirect stimulus, but the massive amounts of money, that's one of the reasons the US market's held up so well. And it has held up magnificently well. I mean, it literally hasn't even corrected an important swing point. It's just been a very, very gentle correction, and look where it is now. Not far off the all-time highs. Very interesting. Okay, let's move on, and you can see how the red lines start to build up. Let's go back and have a look at where I've got this blue elliptical circle. It's not a circle, it's an ellipse, isn't it? And what we're looking at there is I'm simply counting the pink bars and the blue bars, and they're light blue. What do we call them? We put the note on there and say bars not blue, 17 tiers. That's wrong. It's bars not pink. I've got them upside down, but you'll get the idea that you can see a 4 pattern on the first arrow for down bars, and then you've got 17 up bars, and you can progress that along and see just how the blue bars or the bluish bars just dominate this chart and dominate it until this is a 6-day chart, so a fortnight, 2 weeks after the January 2022 high, and then you start to see this pink becoming dominant. You can do this yourself. It's really simple, and just count the bars. And have a look at this last run up to the July this year. You've got essentially 1, 2, 3, 4, 5, 7, 8, 9, 20, 23, 24 odd bars up, and then only 3 pinky corrections. It's back into blue now. So if you are interested in long-term trading, this, in my view, is the best way to do it, that you define exactly what the parameter is that you will accept as a correction against the apparent trend, and that you make that decision before you start entering. Where's the best place to enter? Well, probably the Danielcode blue line trade, if you like. They are the strongest signal we have. They're very, very good, but you must define what your risk on entry is. You're prepared to risk that, and then as the market moves away, you've got the decision: do I cover that risk, or do I let that risk ride? But either way, you certainly never increase it. And that risk should be around 1 ATR, maybe 1 and a bit ATR, not much more. And ATR stands for average true range. So once you've done that, you can see the stages you're going to get off the tram. You're getting a long ride. This is not going to be a plunge, a world-class plunge. This market's been incredibly rational. In fact, you get much better long runs in commodities than you do in equities since the 2022 high. Before that, it was a steam engine, wasn't it? Apart from the COVID correction and the one we saw before that, it was just all one-way traffic, bang, 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 with the angle of attack just getting steeper and steeper. So once you understand how these time cycles can change, you can put an actual time cycle on to protect you, protect your position, and how much you risk It's up to you, but in my view, you shouldn't risk more than one, maybe one and a bit ATR, which is average true range. And that would apply whether you're trading a daily chart or the 6-day chart or even a longer term chart. And here we are, you can see this concept of overbalance of time. In other words, you can see this stuff is pretty simple to count it across. And when time overbalances, it's a lagging change of trend indicator. And here we are for that. Okay, so let's go back. We've been using 6-day chart up to now. This is a daily chart. This is the S&P daily. Just look at how this count works here from the low, which is in really early September, late August actually. Here you've got your 1, 2, 3 blue bars up, and I've written on it 3 blue bars. You then got only 2 pink bars, or not blue bars against. So that puts the balance in favor of this being a bullish move. And look what happens straight after that. 1, 2, 3, 4, 5 bars into high, from which 1, 2, probably 2, maybe you could argue for 3 if you include the inside bar, not blue. So that's how you run this thing. You look at your position, plus and minus. Once you've set that parameter, if it goes against you, you're stopped out, and that's it. Overbalance in price works exactly the same way. This is just a quick look at the US dollar index. Traditionally, what happens with longer-term investors, they'll take a position, in this case a long position, down in the late July, early August low there, and they'll look at what the first correction is. In this case, it's $1,075, and they'll allow that or a little bit more as their measure of price. And an overbalance in price would happen when they get a correction that's bigger than that correction. And as we're moving up this chart, it's amazingly correlated, isn't it? The second correction is $1,030. The third correction is $1,100. There hasn't been much change in the three corrections all the way up until you get a first stronger correction, which is probably the start of a new phase, and it runs to 1,500. So that's the point where you'd be taken out at a pullback of around that 1,000, 1,100 at the most. Okay, so this whole concept of investing and trading, you'll all know about, I'm sure, but most Western governments have created some real, in some cases, enormous tax incentives to encourage folks to save for their retirement. In some countries like Australia, you don't have a choice. The saving portion, which is a percentage determined by the federal government, is deducted from your wages at source, and you can then place it with one of a number of managers who will invest it for you long term until your retirement gives you the right to start drawing against that money. The default is if you don't make that choice, the government will make that choice for you. There are a lot of industry superannuations called superannuation in Australia funds, and they're very, very good. This is all about investment, primarily in the stock market. They've all got their own rules as to what they can invest in and what percentages and what have you. But what's been noticeable lately, according to Bloomberg, is that so many of the big US fund managers are switching to ETFs, and there's a plethora of them that gives them exposure to particular sectors that they may want to be a bit more exposed to. But remember, today's stock market is always changing. We have quarterly rebalancing. If a market like WeWork, for example, trades at a a low price for 30 days, they simply remove it and replace it with something hot and growing and exciting. So it's a bit like if you've got a cup of water and you can drink, say it'll be hot air rises, so it's hot water, it'll be hotter at the top than the bottom. If you keep taking out the cooler water at the bottom and keep topping it up with hot water, it must of necessity rise, and that's that generally high rising, low left to high right that you see on all charts. And that's what brokers and investors base it all on. If you hold your position long enough, you will always do well. Well, that always should have a couple of big asterisks against it, because the reality is you might want your money at a time that's less than optimum for the fund. And if that's so, you'll have to take what you can get. But basically, there needs to be extensive protection for average folks. Don't understand this stuff, don't want to understand this stuff. And basically the whole idea, it's apple pie and mum, really, isn't it? This idea is based on the success of free enterprise, all of these various units that make up the stocks that are bought and invested in by these stocks managers. They've got their own internal management running them in a highly competitive way, and they better do well or they'll be out, and that gives them the incentive to keep it happening. So before we get started in this exciting trading of this week, which I hope you've all noticed has been pretty extraordinary for a short week. It's been quite sensational, but I just wanted to tell you that there's a great opportunity for you to become a super trader, learn how to trade, learn the Danielcode method of trading, which I sincerely believe is the best in the world. I've never seen or heard of anything that is even comparable. And we've got a wonderful testimonial here from Greg Palladini, who's with us today. And Greg's done 2 tutorials with me, and he's been kind enough to run his experience of the tutorial through our forum. And you can go to the link that says forum at the website, go down to the link that says Danielcode trading tutorial or something like that. And Greg's posted a near real-time reports over the time he was doing this latest tutorial of what he learned and what he took from it and how it was. And he's been kind enough to let me use his words here. But great opportunities. If you're ready to do the tutorial now, email me, janeneedham@thedanielcode.com, and we can get you started as soon as possible. And we have got slots available for next week onward. So do email me. That's the guarantee of your success. I sometimes talk about correlations, and as we go through the charts for this great trading from this week that we're having, you'll see a couple there. I say this was a correlated trade, and this was a post that Greg Palladini sent me last week, maybe the week before, and was kind enough to say that I could post it there. And you can see what he's talking about here. I talk about it too often that some of these markets are highly, highly correlated. With Forex, for example, if you've got USD on one side, that market is going to take a similar direction to everything else that's got USD on one side. That correlation is pretty much linear. As well as that, you've got silver and gold, COMEX silver, COMEX gold, which are so highly correlated that a trade in one can be executed in any other. You have the US dollar gold correlation, which is generally an inverse correlation. That dollar up, gold down, gold up, dollar down. And that's been obvious to everyone who trades it for a very, very long time. And I've shown you those charts going back some considerable number of years. So correlations are very good to understand it, because as a general observation, the market that's not quoted in the signal, in other words, you've got to see right here, Greg's telling you, we had a time signal in Russell and the Dow, but he traded the NASDAQ as a correlated market. And the trade in the NASDAQ relative to its investable base was markedly better. He had a very nice over $2,000 profit. And Greg sent me another email later that day saying it was, I don't know, $9,827, whatever it was actually. Really good. But bear in mind this concept of correlated markets. If you take the correlated trade rather than the trade that's actually in the TO3 or TO3 plus signal, you'll find that over time they do considerably better than the nominated account. If you are interested, folks, in understanding time and how it controls our markets, this is an article that's up on the website. It's called The Other Way, The Greatest Story Never Told. And there's the link to the article just up there underneath the heading. It's heavy reading, and not many of you have got through the end of it. Some of you have not even started it, had a look and said too hard. I do urge you to spend the time to read. It is so absolutely extraordinary. It's beyond imagination. You couldn't make this stuff up. And it really is that extraordinary. And if you want to understand the basic of time, do please read that article and give it some thought. Okay, so here we are with a little piece of trading. Have a look at this. It was done this week. This is not real trading. This is a work through, and this is what I do with clients when they've learnt to trade time signals. So if you create and trade time signals, the Danielcode methodology, and this is the S&P, and it starts back in May and runs through. We've got through about half of it. We've got more to go at our next session. But just have a look at that. You can all add it up yourself. Add that up. Take away the red one. Why would you trade anything else? I mean, the only possible reason for long-term investing, honestly, is if you don't know how to trade futures. Because once you get this right, it is extraordinary and amazing. And there it is. You're not going to get anything like that return. This doesn't account for our 2-tick buffer on buying and selling. It doesn't account for slippage. We don't really know if we got stopped out intraday on some of the counter trends, but we've made a fair assumption. And even, if you took a great big bite out of those earnings and said, let's get rid of all of that to try and get somewhere near reality, it's a massive, massive return. If you look at that and study it, then think of a reason why you'd want to trade long term. I can't find one. Okay, now Bonnie and Clyde from Colorado. I just want to share this with you. I've got a delightful couple who live in Colorado. Their names are not Bonnie and Clyde, but they're husband and wife. And he's a very trendy sort of a chap. He's an older chap. He's he's not a youngie by any means. And the wife is absolutely delightful and very, very attractive. But they're talking to me week before last, and they're moving through their tutorial, and they making a start on their paper trading, and they decided they wanted to trade wheat, and they traded wheat for the last 10 months. And this might have been a couple of months ago. Time goes a bit faster when you're aware of it. Okay, I'm coming, guys. I'm just looking at a quote that Greg Palladini, and he's added here in the question box, a DC sell signal, including a time sell, got me short the NASDAQ on September the 1st for more lolly today. Yes, lovely lolly. Well done, Greg. We love the lolly, don't we? That's why we do this. That's our business. It's our business of making money. So anyway, they went through and did that trading, and very diligent people. They took all the actual numbers, not the way I do it. They allowed for the buffer both ways, used realistic estimates of whether the shorter term stops were hit, and they rang me in great excitement, or they didn't ring me, they talked to me on the tutorial go-to-meeting setup with great excitement to tell me they'd made 800% on their account, not on margin, on their account in that 10 months of trading. So that was very exciting. So I opened the spreadsheet, and the spreadsheet was the wrong spreadsheet. It had an attempt to probably doing what my computer just did, going to sleep. And the so I said, well, I can't see it from this spreadsheet. So they couldn't find their actual spreadsheet. So I said, well, just do it again. It's a good experience for you. And I haven't heard a word. And that sometimes happens with my tutorial clients, when they hit it, when they actually find it and understand it, and the pennies dropped. It's like, oh gosh, this is so good. They haven't got time to talk to me. They're away. And they've lost the head spreadsheet. They were going to do it again. I haven't heard from them since. So I guess you excuse me that they're making a whole lot of money. And I want to share with you as well a new tutorial student who's doing his tutorial now. He came to me saying he wanted to trade crypto, and he wanted to do so well that he would get a reputation good enough to run money for others. This gentleman is very serious, very knowledgeable. He's an very senior bureaucrat with the Australian federal government, and by the time he's watched the S&P work through, which I've shown you earlier, that's changed his mind exactly and entirely. And so it should. You shouldn't be having, if you're a serious trader, you shouldn't be having a preference for any market. Our job is to make money, and that's what trading's about, and that's how we measure our performance. And you don't need to have a favorite market. You don't need to want to trade crypto necessarily. I can assure you it's not the best market to trade anyway. What it does have is bags and bags of volatility, but it's got other problems with it as well. Not something I'd recommend anyway. This gentleman, once he's gone through that work through that I showed you a few slides ago, he's all over it. He's all over it. Okay, let's see what we've got here. And quick rundown on how we're doing this week, folks. This is the Aussie US dollar. Now remember, this is a shorter week. A lot of these signals came from last week and just worked their way through. Nice, pretty easy $800 there. Euro US dollar $1,500, $1,600. Same with the British pound. It looked very exciting, this $1,800, this one trade. Remember, all of these trades that have got the US dollar in them in the Forex are correlated, so you couldn't, or you shouldn't at least be trading more than one of these. We have got a young gentleman who lives in England who got very excited about trading 4 or 5 markets. They were all majors in the Forex. In fact, they all had the US dollar in them. So what he was actually doing was just over-gearing on these, because he understood they were correlated, but he didn't understand how correlated they are. You don't want to be trading more than one of a correlated market, folks. Looks like a get-rich-quick scheme, doesn't it, with the lovely lolly you can see here. But the reality is you pretty much had to pick one. Here's the last, I think, of the dollar trades, and it's up almost $1,000. Very nice. Crude oil, had a great run in crude oil. Had a TO3 buy signal that ran up a little bit, $300 or so. Then we had a sell that failed, but the stop and reverse or the flip me was exactly at the high of the setup bar. So we got long again there and made 4,400 before we got stopped out. And that was getting the weekend, so I haven't created another signal. This is the S&P. Have a look at this, the correlated TO3 plus buy signal. Pretty simple. 2,700, 4,100 up and 2,700 down. And the buy signal was a correlated signal. That might be the NASDAQ one that Greg's talking about. Here's our next play today. This is copper, 1,500, straight down. This one's even better. This is the Russell. You had a TO3 plus buy signal at that low, the low of this whole move. It ran up 2,100. It turned around. It's run down into today's close, 2,500. A lazy 4,500 out of one trade there. This is silver. We had a TO3 sell signal. It went down a few hundred, and then we had a flip me, and we had a buy that failed, and we had a flip me on the same day. An outside bar is essentially a flip me signal on day one, whereas flip me trades, as you may know or don't know, are valid for 3 days after the directional trade has been elected. Nice bit of market, this, isn't it? 7,400 just for sitting there and being patient. UST bonds as well, it's trying to rally again. 1,600 in the short position down straight off there. So, consolidations, the curse of trading markets. Try and hoist in these various, there's 3 methods I'm going to show you that will help you avoid correlations. The first of all, I call it the line of 3. And it's a situation where 3, the close, only the close of 3 bars, they don't have to be consecutive bars, they can be 3 out of 3, 3 out of 5, 3 out of 7, doesn't matter what. If you can roughly put a straight line through them and you've got 3 closes at that area, as you've got here, this was the S&P, and you can see that I've made that line across thick, as far as Trade Navigator will allow you to make it thick. But you don't want to be too careful about it. You're not going to be too exact and precise about it. This is just a rough rule of thumb. If you can get a line pretty close to going through 3 bars, not consecutive, any 3 will do, that tells you that you're probably in a consolidation. Now, the only time, once you know Danielcode trading, the only time you need to be neurotic in your trading is if there's a consolidation, because consolidations are different and they do more than just fail. They actually do you damage. You can see this little pattern here. The market ran up into a big high. That's the big high that got you long in this move. Then a little down bar, inside bar, little down bar. Here's the next bar. You get an outside bar up, but it goes out. It gives you what appears to be a breakout at the top. It's not really a breakout because that's not how breakouts work. But then it pulls back, so its close is about in the middle of that range. Then for the next bar, you get a sell signal going down, but look what happens. It runs back off that sell, and the next bar gets you in the middle of that range. And that's what happens in consolidation. So be neurotic. If you think you're in a consolidation, take some action. First thing I wanted to show you was that 3 lines. This is the second method. This is just a rectangle. Trade Navigator's got a function for this that you can use. If you basically, what it does, it's very basic. If you can put the sequence of trades in a box, then by definition it's not trending. And if it's not trending, you shouldn't be trading it. Okay, that's the easiest way in the world. Here is something that clears up this breakout issue. To get a breakout from consolidation, it's not simply that the bar has breached the high and low, and you can see these horizontal bars I put on to signify the high and low of this consolidation, but you actually need a close outside that range. And have a look at this market here in the consolidation. From the starting low, you get a nice big up bar. It's a high, looks like it's got momentum. The next day, immediately, that's reversed and it's taken out, and that big outside down bar closes in the center of that range. Have a look what happened since then. Inside bar,
up bar that reverses. In fact, it's not a key reversal bar because it didn't open within the range of the previous bar, but it's going to act like a key reversal bar, which are directional. So the very next day, there's a sell, down it goes, hits that same level that started us off on the low of the first buy bar that got us into this. But what happens the next day? Reverses completely, closes in the middle of the range. Next day, closes in the middle of the range. Next day, outside bar gaps up, goes through the top of the range, reverses, closes in the range. And that's the problem. And it's not until the bar that I've got indicated, you need a close outside the range of the consolidation. Not just a bar, you need a close outside that consolidation. Now, once you get that, do you jump in and take a trade with the existing trend, or do you wait for another trade signal? Well, the probabilities are about equal. If you jump in, you get a 50% of the time you'll be happy. If you wait for the next time signal, 50% of the time you'll be happy. So it's moot. It doesn't really matter which of those two strategies you decide to take, but you must do the same thing all the time. Okay, so here we are. This is, if you even think there's a consolidation coming, do not trade inside bars. Now, inside bars can be a bit of a trick. They are, for trading purposes, we treat them as a null or a void. We simply ignore them, carry forward the last valid signal we had. Sometimes that's real. Sometimes the basic proposition, it's hard to think about it, is that all markets have their own internal time clock. And when you really drill down into it, as I've done several times, and find out what those time cycles are, they don't make any sense to our sort of linear mind at all. I'm sure it makes sense to the market, but doesn't make sense to anyone with a normally organized brain. But what basically happens is when markets think that they are ahead of their own time, they're running faster than this internal time, they put in inside bars, which are a bit like running on the spot. There's action, but there's no momentum. So that loses time. It gets them back closer to their time they want to be at. Outside bars are exactly the opposite. Outside bars happen when the market thinks it's behind its own internal time clock. It will create an outside bar, which is really 1.5 days or 1.25 days. It fuses a couple of time cycles together. So on this little piece here that we showed you, you could well have thought that was a consolidation in the S&P. The sell signals, the two sell signals that were losers, were triggered by inside bars. So you can see that if you even think you're in a consolidation, the first thing is do not trade inside bars. Trade the last bar that was not itself an inside bar. Okay, and finally, speed lines. This is a very, very old idea, but it's pretty amazing, and you should spend some time setting them up and thinking about it. This chart happens to be the Russell. And generally, markets have two speed lines, two different speed lines up and two different speed lines down. And they'll have a normal speed and they'll have a high speed line. And you can see looking left to right, the first of these lines is the high speed line. The second one of them is the more normal line. But they're created by doing exactly the same thing. For an upward facing speed line, you start from a swing low and it goes through the closing high of the move. You start from a swing low and it goes through the closing high of the rally and the other way if the market's in retreat. Now, if this is the same chart, all we've done is we've taken duplicates of the two speed lines and we've put them down here on top of our latest trading. And you can see the first one that came about. He gave you 1, 2, 3, 4, 5 up bars, closes all above that speed line. Then look what happened on that outside bar. It tells you it's going to be a failure. It gets worse, it goes down further, but it tells you that trade's going to be a failure. Then from that next breakdown low, we put on the fast speed line. It's an exact duplicate. The program does it for you, creates a duplicate. You just right-click on any of these speed lines and click duplicate. I pull that across and put it on that low, and look at that rally up. 1, 2, 3, 4, 5, 6 bars exactly through the close at the high. Pretty nice. That's why the little bar straight after the inside bar that closes below the speed line is telling you that buy trade's over, and it's now going to fail or be a sell, which it was. Okay. Now, if you do have time, folks, I do urge you to go to the Danielcode website. Have a look at the chart archives, where you'll see what I've told you, over 45,000 members charts that I've created for members since late 2007. And you will be flat out trying to find a market that has turned anywhere except as a result of Danielcode target recognition. And that's what makes these Danielcode markets so important as the final filter for any trade that you take. Okay, I think that's probably about us, folks. Remember, the business of trading futures and forex is not to be right. The business is making money, and that's what we do. If you haven't already had a free trial, I invite you to go to the website, www.thedanielcode.com, and start your free trial. If you have any trouble with that process, please email Terry, whose email is support@thedanielcode.com, support@thedanielcode.com, and he will fix that up for you. Finally, here's our disclaimer, which I urge you to read and pay attention to. It's real. If you do not know how to trade, you will lose your money very, very quickly. And it's easy to do, I can assure you. I've seen too many of them. Make sure you learn to trade before you risk any real money. And if you want to learn to trade, there's no better place than right here at the Daniel Code. Shoot me an email, jneedham@thedanielcode.com. And once you've learned it for life. And it is a gift that keeps on giving. Okay, that's us for now. Thanks, folks, for being with us. Greg, thanks for your comment. Much appreciated as always. Everyone else, lovely having you with us, and hope to see you at our next webinar, which will be in a fortnight's time. A fortnight is 2 weeks. For Americans who don't generally use that term, it's an abbreviation of 14 nights. Fortnight, 2 weeks. Greg's son knows about it. The other Greg, Colorado Greg, knows all about what is a fortnight. And that's it from me today, guys. I hope you've enjoyed it, and lady as well. And hello, Gig, you're still with us. That's grand. Back to the golf course for you, mate. And thank you for being with us, and I will look forward to meeting you again at our next webinar in a fortnight. If you have anything special you'd like me to talk about, please email me, jneedham@thedanielcode.com, and I will be ready to do that for you at the next webinar. And that's it for now. So I'll say bye-bye. Enjoy your weekend, which is coming up, and I'll look forward to seeing you on our next occasion. Bye-bye for now.